Dustin here, financial advisor with Jazz Wealth Managers, and today we're going to talk about why 2018 is the year you need to pay down your credit cards. Not motivation, not trying to get you to make a New Year's resolution. I'm going to give you facts and tell you why it's going to cost you more if you don't pay those things down. First things first, the Federal Reserve raised their interest rates just the other week. Now we're up to 1.5%, which is the federal funds rate. That's from zero. We were all the way down to zero. We will never see zero again. So they've been slowly raising rates, and they actually said that in 2018, they're going to raise rates as many as 3 times, but leaving options open. They never commit to anything. So rates could go higher 3 more times in 2018. Now, this actually has nothing to do with your credit cards directly. Indirectly, it's going to cost you more, and the Federal Reserve basically just told you that the cost of your credit cards is going to go up in 2018. Here's how this works. The Fed funds rate, which is what you see on TV when they say up 1.5% or when the Fed raises rates, they're always talking about the Fed funds rates. Now, the geeky side of this is that has nothing to do with your credit cards. What it is this is the interest rate that banks charge each other. Here's a funny story. So the Federal Reserve actually requires that banks and financial institutions keep minimum daily requirements. If they go under those minimum deposits, then they actually have to tell the Federal Reserve. So what the banks decided a while ago was, we don't want to tell the Federal Reserve if we go under. This actually happens pretty frequently, but it's not because they're a bad bank, it's just because money moves so quickly, they may not have the minimum required by the end of the day. So the banks decided, well, we're just going to work together. We're going to start talking to each other. If we're under the minimum required for the day, then one bank just goes to another and says, can I borrow that money overnight so I don't have to tell the Fed? Because could you imagine what happens if you tell the Fed that you don't have enough money per their requirements? Then they're going to come knocking on your door. So the bank said, well, let's just secretly work together. The Federal Reserve is actually cool with this, and they said, tell you what, we'll set the rate. So when a bank goes to another bank to borrow money overnight, that's the federal funds rate. It's essentially the cost of doing business, so you don't have to go to the Fed and tell them you broke their rule. So banks, financial institutions, even myself, we have to have minimum requirements, and if not, we have to answer to the Fed. So here's the deal. When the Fed raises rates, the cost of doing business with another bank that needs help overnight goes up. So overall, that's adding to their cost of doing business. And who do you think pays when a for-profit company incurs more costs? You do. Here's how it works. If they have to spend more money to borrow money overnight, then they're going to charge you more in the form of their prime rate. I know this is a little geeky for the moment, but I'm just feeling good and sharing some information with you. So the prime rate is the best possible rate that you can get at the financial institution that you are currently dealing with. Now, usually what it is the prime rate plus some amount. When it comes to your credit card, if you look at your statement or you look at the actual fine print, it's going to tell you that you're paying the prime rate plus some percentage more. So if the credit card companies have to borrow money from other banks occasionally and they have to pay more, well, they're going to raise their prime rate to you. Now, the Federal Reserve has already said we're going to raise this rate 3 times in the year 2018. Well, what that means is these banks are already preparing, these credit card companies are already preparing to raise rates on you so that they can adjust the cost of them doing business. So your credit card interest rates are variable and they will be going higher. Now, I'm not one of those guys that says you got to pay off your credit card or you shouldn't have any debt, but just know that just like a business, you're getting the heads up that next year the cost of your financial operations is going to go up. Maybe just a fraction, but it's going to go up. So we've got to offset this somehow or start to pay down those credit cards now so it's not a problem when we get to 2018. If you're watching this video already and it's 2018, then ooh, pretty spooky how he knew that was going to happen, huh? No, that's just how it's done. So there's no magic science behind it. Just know that as the federal funds rate goes up, banks have to pay more to deal with each other, and they're going to pass that on to you by raising their prime rate. And chances are, if you're watching this video, you're not getting the prime rate at your bank or at your credit card, so you're paying the prime rate plus a little bit on top of that. which is costing you money to borrow money. So that's it. Did I bore you? Was that too geeky? Did I go too far? Let me know in the comments section if that explanation even made any sense to you. Maybe I just have to redo this entire video, but let me know what you think about this video and how the Fed funds rates works. More importantly, let me know that you're gonna be on track to pay your credit cards down in 2018. If you like what you see, then click that video up there. You might like that too. Otherwise, be sure to hit the subscribe button. That helps us out a lot. Or click the link below to go to our website and click Chat with Jazz. Once you get there, feel free to ask your questions.